Gold futures touching a record again today as investors continue to seek a safe haven as lawmakers in Washington continue with their game of chicken over the debt ceiling. As well, the Federal Reserve pondering more stimulus for the economy. My next guest sees gold heading to $2,000 per ounce and silver retesting the $50 per ounce mark. He also says there are some stocks that you can buy to ride this wave. Here with a look at those market hotspots is John Stephenson, portfolio manager for First Asset Investment Management. He is also the author of the Little Book of Commodity Investing, and he joins us now. John, good to have you with us. Thanks for coming in. Give us the connection that exists between all of the pantomime that seems to be going on in Washington over the debt ceiling. Markets, whether they're fixed income or equities, don't seem to be reacting to any of the issues related to debt ceiling votes or potential negotiations. Why gold? Why silver? Why connect the two?
Yeah, I think if you look at back over the last year or so, you can see how well, in particular, the gold market has done. It's really been very resilient to the potential slowing global economy. So it's held up very well, and I think that's one reason why people want to have that in their portfolios. It's very strong. But what really drives gold, and to a lesser extent silver, is these are quasi-currencies. And at the heart of these debates that are going on in Washington and Brussels is this concern that, one way out of this mess is to print money. And in times when the world is flooded with paper currency and too much of it, this is when gold, and to a lesser degree silver, does particularly well.
All right, let's talk about gold, because if you talk about silver, you end up talking about gold producers anyway. It tends to be that gold and silver are found in the same regions. What about some of the companies, Goldcorp, Barrick? Should those be on investors' screens?
Yeah, I think one of the big themes that's come out of this last few years is the relative underperformance thus far of the equities versus the actual metal. And I think that time has come to an end. Sure, there's been cost inflation, which is the reason why they've underperformed, at least in many investors' eyes. But I think you've got these companies that have particularly strong growth. Goldcorp would be one example. It is the lowest cost producer of all the seniors. And this is a name that will increase production quite dramatically, almost by 60% over the next 4 years. So it has extremely strong production coming on, led by Penasquito, Pascua-Lama, Eleanor, and some of their other mines. And it also has, interestingly enough, about 20% of its revenue coming from silver. So it's sort of a two-for in that sense.
Tell me about Eldorado Gold as well. Is that also one of your picks?
I think this is actually another name that you should look at. It's really gotten hammered because it has some exposure. A lot of its mines are in China, three producing mines in China, the rest in Turkey, and one in Greece. But nonetheless, it has some of the lowest cash costs of any mining company, roughly $435 an ounce, which when you consider that the average has about $850, I think this is extremely attractive. And again, fast growing.
All right, tell me about silver, because we know that silver also has industrial uses. You think that we could end up testing $50 an ounce again for silver?
Yeah, I would say one thing about silver, it has a very narrow window. So it's not a trade for the next 12 months, but probably a trade for the next 6 months. I think you'll see.
Why such a narrow window?
Well, because what I see when I look forward is a relative mine supply increasing in 2012. And 70% of silver comes as a form of a co-product. So it comes from zinc and lead mines. And I think zinc is ending into a deficit, and you'll see more zinc production and hence more silver production. But we have in our forecast a deficit of mine production this year. So I think you have a window of opportunity this year. I think you'll see it hit $50. And I think it will go up because historically it's traded in about a 16 or 17 to 1 ratio, which would imply $90 silver. Of course, I don't think we're going to get that high, but I do think we're going to go higher.
Silver Wheaton, would that be a stock that you'd want to own if you believe the scenario?
Yeah, and one of the great things about Silver Wheaton is it's not a mining company, it's a royalty company.
Right.
So in other words, they just pay for streams of silver. They do a financing in essence. So you don't take any cost overrun risk, any production risk. All it is whether they can continue to sign up contracts, and they're doubling production over the next 10 years as well.
Now, do you favor these companies as investments as opposed to exchange-traded funds like GLD for gold and SLV for silver?
I think those are probably the best ways to play it, is the exchange-traded funds, but a very good second way is through some of these better senior companies because they're playing catch-up to the metal.
All right, I want to thank you very much, John Stephenson. Always a pleasure joining us from First Asset Investment Management and the author of The Little Book of Commodity.